The way most business owners approach tax planning, it's backwards. They start with deductions, write off the meals, track the mileage, and their CPA does their job perfectly, and they're still leaving money on the table every single year. In most situations I see, that gap runs somewhere between $40,000 and $80,000 annually, depending on the structure, income level, and what's been set up. From decisions that happen above the tax return level, before the return is even filed. Those decisions live in three places: your entity structure, your retirement plan design, and how your deductions are actually documented and supported. After 28 years working with business owners at the $750 to multi-million dollar income levels, these are the three I run through with every single client. Most have never had anyone walk them through all three with actual numbers. We're going to do that today. Chapter 2 is where the retirement plan gap tends to live, and it's the one most owners have never had modeled for their actual income levels. And I'll give you a checklist at the end to run this on your own situation. Quick compliance check, then we're straight into the numbers. Everything here is for educational purposes only, not financial, tax, or legal advice. Please work with a qualified professional before making any decisions. Let's get into it. Do you actually know how much your current business structure is costing you in taxes every year? Not just what you paid, but the gap between what you paid and what you could have paid with a different structure in place. Most owners can't answer that because they've never asked, and no one's ever taken the time to run the numbers for them. 3 chapters today: entity structure, retirement plan design, and the deduction layer. And at the end, I'm going to give you a 7-question checklist you can screenshot to audit your own situation. Stay with me for that. So there's one move that you can make that could possibly save more than any deduction. And that's the first move. Getting your structure right tends to be worth more than every deduction in chapter 3 combined. In many situations, depending on your own situation, the difference can run $10,000 to $30,000 a year or more. And here's why. Most business owners think about tax strategy as a deduction problem. Find more deductions, keep more receipts, run more expenses through the business. That's the smallest lever. The largest lever most owners have never pulled is the entity structure, specifically how compensation design interacts with self-employment and payroll tax. Hypothetically speaking, an owner with $400,000 in profit, structured as a sole proprietor, paying close to $60,000 per year in self-employment tax. S-Corp with a reasonable salary at $90,000, that number drops significantly. Nobody had modeled it before. Not because it wasn't available, because no one owned that question. An owner at $250,000 to $400,000 net profit, structured as a sole proprietor or a single member LLC, pays self-employment tax on the full amount, 15.3% on the first $184,500. And that's subject to change, but as of this video, that's where the number sits. Restructure to an S-Corp with the defensible salary of $90,000, payroll tax applies to that salary only, not the distribution I mentioned above it. That delta, in many situations, that's where you get that $10,000 to $30,000 per year, depending on revenue, salary distributions, and state. It's not a loophole. That's how the structure works. The problem is that most business owners have never had anyone run the math for them. When I raise this question, the first question I always receive, why hasn't my CPA done this? Most CPAs are preparers. Their job is to accurately report what happened. Tax planning, modeling what that structure could look like going forward, it's a different discipline, not a failure, it's a different role. So has anyone on your team ever run a side-by-side comparison of your structure versus an alternative using your actual profit numbers? Many times you don't have a deduction problem, you have a structural problem. And structure works at a different level than any individual deduction ever will. 2 things before we move on. The reasonable salary in an S-Corp must be defensible. The IRS standard is what would you pay someone else to do the work you do. That number gets determined in coordination with your CPA. And this move does have a hard deadline. S-Corp elections for the current year are typically due by March 15th. So this is a Q3 and a Q4 planning decision, not an April decision. And what chapter 2 is about to show is that the structure you choose in chapter 1 determines the ceiling of what's available in chapter 2. So chapter 2, the retirement account, most business owners are leaving empty. Most business owners have retirement accounts, a SEP IRA, a solo 401k, maybe just a regular IRA from earlier in their careers. What gets contributed each year is usually whatever felt manageable, not whatever the structure actually allows. The gap between what most owners are contributing and what's available is a direct tax gap. Every dollar into the right plan type is a dollar that doesn't get taxed this year. The IRA most people default to allows for $7,500 per year, subject to change. A solo 401k for an owner with no full-time employees can allow up to $72,000 or more, depending on income, structure, same person, different instrument. Cash balance plans go further. For an owner 45 or older with stable income above $300,000 who wants to shelter the maximum before exit, a cash balance plan layered on top of the 401k can push annual contributions to $150,000, $200,000, even as high as $300,000 plus. Now that's going to be subject to actuarial calculations, and there are some annual plan limits, but I've got clients putting over $350,000 away into that type of structure. So here's an example I see in my practice. Hypothetically speaking, a medical practice doing roughly 1.2 million in revenue. Owners in their early 50s, strong, stable income, planning to work another 8 to 10 years, had been maxing a SEP IRA for 6 years, contributing roughly $60,000 per year. Nobody had ever asked whether that was the right plan for where their practice was now. When we modeled a cash balance plan layered on top of a 401k, the contribution potential was multiple of what the SEP allowed, with a corresponding reduction in taxable income that year. The plan type hadn't changed, the income had, and nobody had ever revisited the question. The pattern, set it up early, never look at it again, is what I see most people consistently do at this income level. Has your current advisor or your CPA ever presented to you a comparison of plan types? Not a product pitch, a structural comparison based on your income levels today. The retirement account you have isn't necessarily the one you're entitled to. The right plan type is determined by your income level, your entity structure, and your timeline, not by what was convenient to open. And one more connection before chapter 3. Everything in this chapter depends on chapter 1. The contribution limits available to you and the plan types you qualify for run through your entity structure. Structure comes first, plan design follows. If this has you thinking and you have questions that are better for a conversation, then a comment below. There's a link below to set up a 20-minute chat. Let's keep going. And chapter 3, the deductions that actually survive and how to set them up correctly. Before we go through the deduction layer, here's the frame I want you to carry into it. Deductions are the third layer, not the strategy. An owner who captures $15,000 in deductions while leaving $80,000 on the floor from the first 2 chapters we covered is working from the bottom of the stack up. We're covering this last because that's where it belongs. That said, the 3 deductions that come up most often are real, and we're setting up correctly. 2 more minutes and I'll show you the 7 questions. Have your phone ready so you can take that screenshot. Now, the difference between a deduction that holds and one that creates exposure is almost always documentation, not intent. Home office, legitimate for dedicated, exclusive use space, not the dining room table, not the guest bedroom that also has a desk, a space used regularly and exclusively for business. If that's you, the square footage calculation is straightforward and the deduction is real. Now, if it's not exclusively that, then skip it. The exposure isn't worth the deduction. Vehicle deductions, Section 129 and bonus depreciation are available for business vehicles, and the numbers can be meaningful. What makes or breaks a deduction is the mileage log, recorded at the time of the trip, not reconstructed at year end. Date, destination, business purpose. Most owners know they can deduct vehicle use. Far fewer have the log that would hold up if requested. The log is the deduction. Hiring children. If your children are old enough to do legitimate work, social media, admin, filing, paying reasonable wages for real documented work is deductible. And the income shifts from the owner's bracket of up to 37% to the child's bracket, which is often zero. But the structure has to hold documented job, documented duties, a reasonable wage, and formal payroll, not cash. The ones that survive scrutiny from the IRS are set up like real employment. Here's what connects all three chapters. Deadlines, S-Corp elections for current tax year, typically March 15th. Retirement plan contributions. They have tax filing deadlines with extensions. Deductions. The system has to be in place before you try to claim it. You cannot backfill a mileage log. You cannot retroactively set up a formal payroll. These are Q3 and Q4 decisions, not April decisions. Has anyone on your team ever reviewed these three areas together, structure, plan design, and deduction documentation, before the end of the year, when there's still time to act on them? The deduction is the smallest lever. The structure and the plan design are where the real decisions live. And both of them have to be placed before the deductions can do their job. The structure review, the retirement plan comparison, the documentation system, those fall through unless someone is looking at all of them together before the deadlines with time to coordinate with your CPA and your attorney. That's the role I play. I'm a business owner. I'm a certified financial planner. The model at Tribach is built around quarterly sprints on three pillars, and they're what define our company here. We help clients think through cash flow. We help them protect and grow what they built. And when those two foundations are in place, they can approach investment decisions from a position of clarity rather than pressure. Cash protection investments. We're not CPAs, we're not attorneys, but we make sure those relationships are coordinated so the tax plan, the legal structure, and the financial plan are all working from the same picture. That's the role of a personal CFO. Even with all of this in place, structure correct, planning design correct, deduction documentation in order, the pattern I still see is the timing. The owner at the $600,000 level who finally got everything right and then crossed 1.2 million and nobody ever revisited the structure. The decisions that were right at 600,000 aren't automatically right at 1.2 million. The structure gap alone, that revenue level can run 20 to 40,000 a year in many situations, and it doesn't announce itself. It runs quietly until someone asks the questions and helps coordinate it. You came into this thinking about deductions. You're leaving with structure, plan design, and documentation. And here are the questions worth taking with you. Has anyone ever run side-by-side comparison of your current entity structure versus alternatives using your actual profits? Number two, do you know which retirement plan type you qualify for at your current income level, and are you contributing anywhere near the actual ceiling? And three, for the deductions you're currently taking, do you have documentation in place that would hold up if you were asked for those documents? If those questions don't have a clear answer, that's not a problem with your CPA or your advisor. It's a gap in what anyone has been asked to look at. And if one of these three areas hit home, drop it in the comments below. Just put the number 1, 2, 3. I read every one. Before I let you go, here's a checklist. Take a screenshot. And if this sparked questions and you want to connect about them, reach out using the link below. Set up a 20-minute chat. I'm here to help, whether it makes sense for us to talk further or work together or not. I enjoy these conversations, and I do appreciate you watching. I'm John Rojas. I'll see you next week.